In the ever-evolving landscape of finance, the arrival of AI-powered funds presents a pivotal moment in investment strategy. For years, investors have relied on index funds as a proven method to grow their wealth steadily. These funds, by mirroring the performance of a market index, have offered a combination of safety, simplicity, and reliability. They are essentially the tortoises of the investment world, slow and steady, yet consistent in delivering results. However, as we step into 2025, the financial world is witnessing a dramatic shift with the introduction of AI-powered funds. These innovative investment vehicles harness the power of artificial intelligence to sift through vast amounts of data, analyze market trends, and execute trades with remarkable speed and precision. Imagine an investor who never sleeps and processes information at lightning speed. That's what AI brings to the table. The core question remains: are AI funds truly the next big thing, or will traditional index funds hold their ground? Proponents of AI funds tout their ability to adapt to changing market conditions in real time. They can react to news events or sudden market shifts within moments, potentially leading to higher returns than the traditional model. Furthermore, AI can identify patterns in data that human investors might miss, opening doors to previously unexplored investment opportunities. On the flip side, index funds come with a level of comfort and predictability that many investors cherish. Their long-term track record of performance speaks volumes. Investors can rest easy knowing that their portfolio is diversified and is not subject to the whims of unpredictable algorithms. Additionally, index funds tend to have lower fees, making them an attractive choice for the cost-conscious investor. As the debate rages on, the future could see a coexistence of both investment strategies. Investors might opt for a blend of index and AI funds, tapping into the strengths of each. Those who appreciate the reliability of index funds might gradually introduce AI components into their portfolios as they gain confidence in this emerging technology. In conclusion, the financial landscape is undoubtedly changing. While AI-powered funds present exciting new possibilities, traditional index funds remain a reliable choice for many. The key for investors lies in understanding their unique risk tolerance and investment goals as they navigate through these evolving options. The future of investing may not be a race, but rather a thoughtful integration of the old and the new. Index funds serve as a gateway to investing in the stock market without the complexity often associated with it. Picture yourself stepping into a vast garden filled with flourishing plants. Each plant represents a different company in the market. Index funds allow you to invest in a collection of these top-performing companies, capturing the growth of entire sectors through a single investment. The S&P 500, for instance, is a well-known index that includes 500 of the largest U.S. companies, offering a slice of their success with just one fund purchase. Investing in index funds brings the concept of diversification to life. Instead of planting all your seeds in one unpredictable spot, you spread them across a well-tended garden. Each index fund represents shares from hundreds of companies, mitigating the risk associated with individual stock investments. This means that even if one plant struggles, the overall garden can still thrive due to the healthy plants surrounding it. Thus, you're not relying on a single stock to flourish. Your investment is sheltered under the broad umbrella of market performance. Cost-effectiveness is another significant advantage of index funds. Imagine building a beautiful home without breaking the bank. That's what investing in index funds can feel like. Funds like Vanguard's VOO or Schwab's SWPPX come with impressively low expense ratios, often below 0.05%. As a result, more of your money is working for you rather than being swallowed by fees. Historically, these funds have outperformed many active investors over extended periods, emphasizing the wisdom of letting the market reveal its winners over time rather than taking risky bets on individual stocks. The stability offered by index funds can also be visualized through a sturdy oak tree against the elements. These funds tend to weather market fluctuations better than more volatile investment options, providing reliable growth and peace of mind for investors. This time-tested approach appeals to both beginners and seasoned investors alike, simplifying the investment process significantly. It's a refreshing take on building wealth that prioritizes long-term success over short-term speculation. With index funds, you embrace a thoughtful, patient strategy that prioritizes stability, low costs, and proven growth. Artificial intelligence (AI) funds are carving a unique niche in the investment landscape. Unlike traditional mutual funds or ETFs that rely heavily on human analysis, AI funds leverage advanced algorithms and machine learning to make investment decisions. These funds, such as the AI EQ ETF or Craft AI-powered ETFs, use AI to analyze vast amounts of data which is updated in real time, effectively enabling them to capitalize on new information faster than human investors can. At the core of AI funds is the ability to process thousands of data points every second. They don't just glance over stock prices, they delve deep into earnings reports, digest news headlines, and even consider social media sentiment. This innovative approach translates to a level of insight and analytical capability that far exceeds typical human investment strategies. Surgeons of the financial world, these AI systems operate in the kind of relentless and efficient manner that human minds cannot sustain, tirelessly scanning and reacting to market changes. The primary objective of AI funds is to enhance investment outcomes by making quicker, more informed decisions. Unlike traditional investing models where strategies may become outdated in the face of rapidly shifting market conditions, AI funds continuously predict market shifts. They adjust their portfolios almost instantaneously, reflecting a dynamic investing style that goes beyond merely tracking an index, as traditional funds often do. This rebalancing in real time is pivotal, especially as market volatility increases and traditional strategies struggle to keep pace. As we move towards 2025, the implications of AI becoming more advanced in this field are profound. Investors are increasingly turning to AI funds, eager to harness the potential benefits of a technology that promises to redefine what it means to invest wisely. The buzz around this innovative investment approach signals a desire among investors for an edge that traditional methods cannot provide. As AI funds continue to emerge and evolve, they represent not just a trend but the future of investment, combining technology with market strategies to create smarter and potentially more lucrative options for those willing to embrace the change. As we navigate through 2025, investors are faced with a crucial question: which investment strategy performs better? The landscape of investing has been transformed by technology, leading to the rise of AI-based funds that promise impressive short-term returns, especially during periods of market volatility. These innovative funds have shown remarkable agility, capitalizing when tech stocks soar while minimizing exposure when energy stocks take a hit. Yet amidst the excitement surrounding AI funds, there remains an age-old champion in the investment arena: index funds. Renowned for their stability and cost efficiency, index funds have consistently demonstrated their value over the long haul. They offer a proven track record that doesn't waver with market trends or sudden economic shifts. Nevertheless, it is essential to acknowledge that AI funds are relatively new players in this game, still finding their footing in the investment world. It's vital to remain cautious with AI funds, as they are only as good as the models and data driving them. A sudden shift in data or unexpected global events can drastically impact predictions, leading to possible miscalculations and investment risks. Therefore, despite their potential for significant short-term gains, one must weigh the risks they pose against the stability offered by traditional investments. For those striving to build long-term wealth, index funds emerge as the steadfast companion in your investment journey. They are simple to understand, require minimal maintenance, and their consistent performance can lead to impressive returns over time. However, embracing a balanced approach might be the key. If you consider yourself tech-savvy and are willing to accept a bit of risk, allocating a small percentage of your portfolio, perhaps 5 to 10%, into AI funds, allows you to harness the benefits of innovation while remaining grounded in traditional investment principles. This dual strategy proposes having the best of both worlds: the dependable foundation of index funds intertwined with the exhilarating prospects that AI funds offer. As investors look to the future, the choice between Team Index and Team AI becomes a matter of personal preference and financial strategy. Ultimately, it's not about trying to time the market or chase fleeting trends. It's about being patient and investing with intention over time. So, as we close this discussion about investment strategies in 2025, consider your goals and risk tolerance, and remember to embrace the journey with an eye on the long term. Share your thoughts and strategies in the comments below, and stay tuned for more insights on smart investing.